Well, welcome back to the Contrarian, everybody. It's my pleasure to bring on David Hunter again. Last time I spoke with you, David, actually was right during the yen carry trade unwind during last August. And since then, we've had a lot of things transpire. Of course, we've seen the markets march considerably higher into the end of 2024. We then saw, tariff concerns and then the Liberation Day sell-off up until recently, and then we've seen markets recover. Of course, gold and silver have gone higher in the last 8 months as well. So, thank you so much for coming back on, and I look forward to our conversation today.
Yeah, thanks, Logan. Thanks for having me on. Yeah, it's interesting. I didn't realize that was when we last spoke. That is seems like a lifetime away, right? Given what's transpired in the last many months, but it just goes to show you, if you think back to that time, everybody was panicked and had all kinds of gloom and doom coming out of what was going on in Japan, and none of that panned out. So it's kind of a lesson to investors: pay attention to the news, but don't think the news is the all important decision maker in terms of markets.
Exactly. So, yeah, David, I think it'd be great just to maybe bring investors up to speed, like what you're seeing right now, what your forecasts are coming up. I'm guessing, I've heard recent interviews you've done. It sounds like just a continuation of the melt up, probably entering kind of the final parabolic stage as you forecasted. I'm curious to, yeah, hear your expectations for what that could look like.
Sure. Yeah, my forecast is pretty much the same. I have raised targets in recent months, so my S&P target has moved up to 8,000 from 7,500. My Nasdaq target has moved up to 27,000 from 25,000. My Russell and Dow targets I have not changed. I may end up raising any of those four indexes going forward. I do believe we're in the final leg of what I've been calling a 42-year, now soon to be a 43-year secular bull market. So I think we're going to put in a top this year, could put it in by the end of the summer, could put it in this fall, but I think we'll probably see a top this year. And I think the targets I've just laid out are, if anything, conservative. So I'm pretty comfortable. I'm certainly the most bullish analyst on the street. In fact, given what happened back in early April, a lot of people are pretty skeptical of this market. They turned bearish then, and that's what actually at the bottom is when, very close to the bottom, is when I raised my targets, while everybody else on the street was lowering targets and saying the top is in. I was even going higher. So, and that's how I work. I mean, the sentiment was getting just so negative, and that's basically future buying power. So, I looked at it and said, no, we actually are going to have a bigger leg, this final leg. So, I call it a parabolic leg. I think it will, as it moves towards the top, get steeper and steeper until it actually is going vertical. And that's really why I argue that my 8,000 is a good number right now, but when you get into that final crazy phase where everything's kind of going up straight up, it's hard to pinpoint a number. So I'm comfortable with 8,000, but it could go to 9,000 for all I know. But it should be short term. It'll all happen pretty fast. In terms of bonds, which has been in the headlines a lot in the last few months, with people fearing that rates are going a lot higher. I think rates have peaked. I think we saw over a year ago, I think it was probably October of 23, that we topped out at over, at 5% on the 10-year, and worked our way down to under 4%, and then it bounced back to, went to 470, and now we're in the 440 area. I'm very comfortable with a bullish view on bonds. I think you're going to see a sharp decline in rates over the next year. Some of that will happen during this final leg of the bull market, the equity bull market, and some of it will happen when the economy rolls over and we're in what I'm saying is going to be a global bust. That's where you'll see the biggest move in rates down. But I do think you could, over the course of the next 6 months, see rates drop from the current 440 area down to as low as 2.5.
Okay. That might actually be your most contrarian call right now, it would seem, because I don't really see any other people who are very bullish on bonds right now. It seems like the consensus is either that rates are going higher or they're kind of just staying at this relatively elevated level like they have been for the last 2 years. But you're saying that it looks like maybe from a technical perspective that, like on the longer end of the curve, the 30-year and the 10-year probably topping out here and could roll over soon. And from that, you could get mortgage rates going lower, you could get auto rates going lower and things like that, that could almost be stimulative in effect.
Yeah, that's true. It's both technical and fundamental. I do think the economy is softening and will continue to soften through the summer. A lot of that is, I think, the tariffs and the adjustments consumers are making because of what will probably be higher prices. So we've got, first of all, people buying ahead of the tariff hikes, saying, I know prices are going to be higher, so I may as well buy now, whether it be, cars, appliances, bigger ticket items, or even some other things that are influenced by, clothing, et cetera, influenced by tariffs. I think that just naturally you look at it and say, if we're seeing, a stronger second quarter, a lot of that is that buying ahead of the tariffs. That only means that the third and fourth quarters could be lower, and, could be weaker. And I think that's part of it. The Fed is still restrictive. That's another part of why I think the economy can slow. And so, and the Fed, frankly, with the meeting yesterday, seems to be ignoring the weakness, because we're seeing weakness in spite of people buying ahead, in spite of the fact that the second quarter is probably getting some bounce from that. We are seeing under the surface, factory orders and ISM indexes and things like that are coming in pretty weak. Consumer confidence bounced, but I think will weaken again. So I think there are lots of fundamental reasons why rates can come down, as well as technical. My read of the technicals look solid too. So, unfortunately, people get caught in thinking everything interest rate driven is driven by the Fed, so they pay attention to what the Fed says and does, and that holds them to a view that rates can go up because the Fed's talking about not dropping rates here and watching for higher inflation, et cetera. So they're nervous. When you look at the sentiment on bonds, it's very negative, and I think that's, again, just like it was in the stock market, a sign of a bottom, not a top. So in bonds, so I think there's a big runway ahead in bonds. Stocks will outperform here through the summer, but bonds will be trading up, and then you'll have a real big move in bonds if and when the economy really starts rolling over hard. And so that's part of my bullish case for stocks is lower interest rates. I'm not worried that the Fed is not cutting yet. As I say all the time on X, the bond market tends to lead the Fed. So the Fed will follow along, and that will be added impetus for the stock market, I think, later in the summer. They will ultimately cut, I believe. They may not know that yet, but I'm pretty sure they will. But interest rates are coming down anyway, because the bond market will be moving up and driving rates lower.
Okay, that makes sense then. I mean, yeah, it is kind of another incorrect perception a lot of people have, is just that, that all the rates are controlled by the Fed. No, it is just the Fed funds rate that they directly control. I'm curious with, like, because you're forecasting this melt up, historic melt up, pretty much all equities across the board and bonds and gold and silver. So it sounds like pretty much every asset class rallying during that melt up. But at the same time, you're seeing, and I see it too, just a lot of current economic weakness, probably increasingly weak economy going forward. And it might seem like those two views might be conflicting, but you're actually forecasting a melt up in spite of that. So do you think investors are going to kind of be too optimistic in light of that? Like they'll see, oh, the Fed can now cut rates. It's a soft landing. That'll be kind of the whole narrative driving the melt up, and then of course fear of missing out and everything else that just contributes to momentum.
Yeah, exactly. I think we used to call it Goldilocks, or it's been called in the past the Goldilocks scenario, where you have a soft landing. So in investors' mind, even though I think we're headed for a hard landing, in investors' minds, the data will support a view of a soft landing for probably several more months, at least a few more months. Um, and that will help bring rates down because it's soft. The economy is soft. That will help bring inflation down. I know that the Fed's very worried that tariffs are going to push inflation up, et cetera. I don't think you're going to see much of an uptick in inflation. And when you look through the numbers, I think you'll see plenty of reasons, particularly in the housing area, to continue to say it looks like inflation's trending towards their target. So you'll have that, and the companies have continued to show resilience in terms of managing their earnings. Quarter to quarter to quarter, everybody keeps thinking, "Oh, this is the quarter we're going to get disappointed," and they play the game of obviously, if they're going to have to lower numbers, they lower them ahead of time, and then when they report, they're in line or above expectations typically. So that's part of it. But generally, our companies, particularly in the tech sector, have been very resilient. All the doom and gloomers out there that were calling for big earnings adjustments downward have been disappointed. You haven't gotten that. You still have forecasters out there calling for lower S&P numbers, et cetera. But generally, I think earnings are going to hold together pretty good. Not that they're going to skyrocket here because the economy is softening, but I think the companies have a control over costs and are going to continue to report inline numbers, with some surprising on the upside, of course. So you got all of that, and it supports the stock market, obviously the bond market, given my scenario, and the metals market. So yeah, it seems like we're in a sweet spot where they can all go up. Now the funny thing is, people have in their mind that metals only go against stock market, so the stock market has to go down to get metals up, or at the very least, stock market can't be doing much because the metals don't do well in bull market. So that's not really true. You go back to the first decade of this century, and there were periods where they both did very well. There were periods when they didn't, but there were periods. So sometimes the metals move with the markets, and sometimes they go against them. In this final melt up phase, yes, I think you're going to have both metals and equities going up together. And by the way, it's funny because people, they hear the big picture, but then they want to see it every day, and that's you could have a situation where the metal, we've kind of had it in the last few months, where the metals move up big on days when the stock market pulls back, but when the dust settles and you look through the months or the quarter, both moved up a lot. So it doesn't mean that they both move up every single day together. It's just in general, you're going to see over the course of the summer and into the fall, I think, both the equity markets and the metals markets move up together.
Okay, so yeah, I think that makes sense with how you're laying it out. And let's maybe touch a little bit. We didn't talk yet about gold and silver and commodities, but sounds like you're very bullish on those as well. You recently raised your target on gold to 4,000, I believe,
Yep.
pre-bust.
Yep.
Silver is still 70, is that right?
75. Yeah, my
Okay.
75 target on silver has been there for quite a while. And when I raised gold, and I actually raised gold twice in the time that silver stayed at 75. So silver still got a long ways to go to get to its target, whereas gold has gotten, my original target was 3,000. I raised that to 3,400 maybe a year ago or last summer. I can't remember exactly, and then raised it to 4,000 in April. So My belief is, and actually, if you step back, everybody thinks silver is disappointed, but from the lows of a couple of years ago, both gold and silver pretty much tracked along together. So both are basically doubles off of those lows. It's just that silver typically outperforms in a bull market, and it hasn't done that yet. I think that's about to change, or is in the process of changing now, where you're going to see silver outperform gold. They'll both do well. Gold is, going to 4,000 from 3,400 is a pretty good run, but silver going from say 37 to 75 is a lot bigger run. So I think that's what I think the next 3 to 6 months is going to look like.
Yeah, that absolutely is an outperformance on the part of silver. I've tried to think about it in the past, and I haven't really settled on a reason in terms of why silver typically outperforms. Is it the fact that some investors miss getting into gold early and then they see silver as an easier way to do that in the kind of later stage, and that's what drives silver up so, you know, much higher volatility than what gold experiences?
Yeah, it's a couple things. I think silver is poor man's gold. So yes, there's when you get the retail on board, and institutions start looking, they'll say, gold looks more extended, so I'm going to start buying into silver because it will track gold or better. So it's somewhat, yeah, that poor man's gold alternative, and it's obviously one's at 3,400 and the others at 37, much more affordable to the retail investor. So it's partly that. It's obviously the tape as the momentum goes. People get more speculative, and silver is a more speculative metal. It's also that when you enter that stage where silver really is going, part of that is because there's a higher confidence that things are okay. Gold can play when there's trouble out there. Gold can be both an offensive and a defensive asset. And that's another thing people misunderstand. They only think of gold as a defensive asset, and obviously that's been proven wrong in recent years. But it does, when you've got a situation like the Middle East, it certainly supports gold. Interestingly, though, gold's been kind of waffling here for a little bit, the last week or more, at a time when you have heightened risks in the Middle East. So that's interesting, and that just shows you when something gets overbought, or gets in favor too much, even the news can't drive it higher. Sometimes it just needs that pause. The pause can be pretty shallow, but while it's pausing, it kind of rebuilds its, the sentiment gets more negative, it rebuilds its ability to move. The wall worry allows it to move higher later on. So, I think gold's acting great. I'm not worried about this very short term pullback. Silver looks really good. Silver broke out from, at least a couple year period, longer than that probably, to 137 recently. So I think that one's alive and well and ready to run.
Okay, so maybe let's touch then on the leaders in the melt up. It sounds like you're very bullish silver and the gold and silver miners, which have tracked gold but probably not outperformed as much as might be typical. And it also sounded like you're very bullish on the small caps still, as well as tech. So yeah, maybe lay out what you're most bullish on in the melt up.
Yeah, I think you named some of them for sure. I think the miners are, as if my numbers are right on the metals, the miners have a lot of upside ahead, and they do look like they're coming out of very long bases in many cases, and just beginning to move up. So I think there's big runs ahead in the miners, and this is just pre-bust. There's going to be even far bigger runs post-bust, and then a big correction during the bust. But we're just talking pre-bust. I've got a target on, a long held target in the gold miners of 65 for GDX and 100 for GDXJ, and they're not that far away. I mean, GXJ is still, 35% away or whatever it is, maybe 40%. But GDX, got up to 55. It's only $10 from my target that I've had for probably 5 years. So there's room there to be for those targets to be raised. I haven't done it yet, but I could. Um, Silver miners, my SIL target is 75. Still a good ways away, but not that far. It was a lot farther away not that long ago. SILJ is currently 15-ish, and I have a 35 target, so that one's got a good distance to go. But even there, I think, the minor, that shows you what kind of upside I think we have this year from here. So I think miners will be certainly leaders in this in terms of performance leaders in this last leg. They could keep going beyond the top in the indexes. People, I make that comment. I've made that comment over the years. And people want to pinpoint it. It's not a precise thing. It doesn't have to happen that way. It's just they have farther to go. They're later cycle. So it just stands to reason that you could have the indexes top out, you know, say in September, and the metals, the miners top out, 2 or 3 months later, or a month later. So, but there's no rhyme or reason. There's no precise timing of that. They could top out. They could have bigger runs and top out with the indexes. It's kind of a side comment that people take too seriously. It's just the likelihood is they could go beyond the index top. So all I'm saying is if the market tops, that doesn't mean everything tops at once. Some of the later cycle things like miners typically could top later. Other leaders, yes, tech. I think the Mag 7 will continue to play. I know you got some things like Apple where they've struggled recently because of some of it because of what Trump's doing, in terms of tariffs and the kind of back and forth with Tim Cook on that, wanting them to bring iPhone's production here, which seems kind of not likely. They're moving from China to India, which I think is a good move. But when you think about it, even Apple, if ultimately he slaps a 25% tariff on imported iPhones, um, it's such a premier product that I think it's not going to hit Apple's sales in a big way. There could be an adjustment period, but so I'm not bearish on. I don't talk about individual stocks, but I mean, that's not a stock I would be all that concerned that it's different than the rest of the Mag 7. I think it'll have a catch up rally, um, and basically across the board, semiconductors in the tech area, I think, will be leaders. You're going to see. SMH, I have a target of 400. It's at 260-ish. So that shows you there's quite a bit more to go. And I think
Yeah.
my 400 could prove conservative. And then beyond that, the financials, I think, in spite of all the concerns out there about, and even for me, saying the economy's slowing and all of that, the financials look good. I think the banks will do well. The brokers will do very well. And so those are another area. I think industrials are at new highs. The indexes are still a couple percent below their old high, their all-time highs. I think the industrials, the XLI has gone to new highs already. So that shows you that strength. Basic industry, materials, I think will catch up. They've been they look fine, and I think they will be leaders in this final move. By the way, a lot of this also is weak dollar. That's going to be another impetus. Is weak dollar will help resource companies, will help gold and silver, et cetera, at least in U.S. dollar terms. And then even consumer, as much as I think the consumer is starting to get tired and has a lot thrown at it that's going to start hitting it. Even the consumer, I think, as you mentioned before, as rates come down, that will probably stimulate some consumer buying in areas. Um, so even the consumer, I think, will be a big participant in consumer stocks in this final leg. The areas that lag will typically be things like utilities. Doesn't mean they won't go up; they'll just not perform as well as the market. Consumer staples, food, healthcare is certainly getting hit because of some of the policies the new administration is putting in, and I think rightfully so. They're getting hit, and energy, which has come alive because of the Middle East conflict. I don't think that has legs. I think that will not go very far. Now, that's assuming things play out as, at least as I think they will, that Israel has the upper hand and Iran's going to have to, at some point, capitulate. Whether we go in and bomb them, which I think is a real possibility, bomb their nuclear facilities that are deep in the ground, or whether they just kind of negotiate, something that basically takes their nuclear capabilities off the table. One way or the other, I think that's the likely outcome. And in that case, I think energy goes back down, could go back down towards the lows of this year, down towards 55. If the conflict stretches out, all bets are off. It could go higher, but my guess is energy is going to be one of the laggards, energy stocks. Um, so
Okay. No, thank you so much for laying that out, the leaders and the laggards. And then you also briefly mentioned it there of just kind of the current headlines and concerns, spike in energy that is going on as a result of the, Iranian Israel conflict. And I maybe wanted to touch on that too, because let's say like worst case scenario, there's another prolonged US involvement there and Iran tries to, restrict oil as much as possible or something, because higher oil would definitely send inflation higher, could hurt the US and the rest of the Western world. Could that be something that might get in the way of your melt up thesis, or is the worst case scenario still not that big of a concern globally speaking? Or,
yeah, it's a tough one because I don't want to ever say that war would be couldn't be bad, and that it couldn't turn into something much more prolonged and drag us all into a world war. I mean, those are all possibilities that I can't predict, but I can say I think they're low probabilities, and this is a probability business. So I don't consider them a serious challenge to my forecast at this point. Things could change. What some people don't understand. Keynes, to paraphrase John Maynard Keynes years ago, back in the 30s, when he was challenged about a forecast or something. He's a kind of long time economist at that time, said, when the facts change, I change, good sir. What do you do? So, it is. I'm not a two-handed economist where as you know, I don't hedge a lot. So I don't play the on one hand, this is my forecast. On the other hand, this is my forecast. I don't hedge a lot. I tell you what I see and what I think is the high probability thing. Doesn't mean I'm always going to be right. Doesn't mean I can't change my mind. But as things stand right now, I think the likelihood, the high probability call is my forecast. And the high probability is that Israel and Iran will be contained, that this won't turn into World War III, that that the U.S. could very well enter it from the standpoint of our B-2 bomber dropping the Moab bombs to get deep into the mountains to get the nuclear facilities, but not extend beyond that. I don't see the U.S. getting drawn into a prolonged war. So again, I just want people to be clear. There's nobody that can tell you with certainty that things couldn't get worse or be far worse than my forecast. My forecast is only as good as my assumptions, but my forecast is based on what I see on a probability basis. And I think I continue to call this a high conviction forecast for me.
Yeah, thanks for touching on that because I know oftentimes like the headlines and just the activity on Twitter and social media can kind of amplify the day-to-day news to where I feel like we oftentimes lose perspective of just the bigger picture that's always, that's been there for decades in the works.
Yeah,
Um,
as
but
I like to say, my forecasts are based on my macro analysis, my technical analysis, my fundamental analysis overall, looking at industries, et cetera, um, sentiment, and then cross markets, which means looking at various things. So if I'm looking to forecast stock market, I'm also looking at what are some of the underlying sectors looking like technically and fundamentally, et cetera. Is the bond market sending a different signal than the stock market? Those kind of things. So when I put all that together, it gives me more conviction. If I only got two or three of those different sets of analysis agreeing and others are not, I can't have the same conviction. But when everything is kind of coming together and adding to the same conclusion, or coming to the same conclusion, it gives me great confidence in terms of my forecast. And that's why I do tend to be not unique on the street, but certainly rare on the street to have an unhedged forecast. My forecasts are pretty much black and white. And as I said before, that doesn't mean I'm going to be right. So people have to be, investors have to be careful and say, well, he's always right, so I'm going to go with that. Not necessarily the case. On the other hand, I want to make this clear because sometimes when I start explaining what I do, and I've done it for years this way, um, I'll get somebody on Twitter saying, well, I see you're starting to hedge your bets, or you're starting to sound less confident in your forecast. No, not at all. This is just an explanation. I could have said the same thing 2 years ago or a year ago on how I approach things. So no, I'm not just because I'm restating something I've said before that I can be wrong doesn't mean I'm getting, that my convictions are dropping or anything. I'm just being realistic and explaining to people, world events can enter in and change things. As I see things right now, my convictions are as high as ever that we're heading we're in a final leg, heading for a very steep run here into a 43-year top.
yeah, and then maybe going into the next, high conviction call of yours is the upcoming kind of financial bust or financial crisis. What are some likely contributing factors for that that you see? Is it kind of the extreme speculation that might come in the melt up? Is it the leverage that's been, going on for the last several decades that's just been building on top of itself? I mean, yeah, what really leads to this bust?
Yeah. So I think when I call it a bust, it's something bigger. I think something bigger, at least financially bigger than 2008-9. 2008-9 was the biggest financial crisis in our history. It was big. It caused all kinds of dislocation. So to say we're going to come back to back with something that might be even bigger is it surprises me. I mean, I've been saying it for a while, but when I started seeing what could lead to this, I said, we know that typically in history, you don't get back to back things like that because people learn from the last cycle and don't make the same mistakes. But things are kind of falling into place and have been for years that lead me to believe that we can get something similar but worse than 2008-9. And the biggest reason for that is the leverage. One lesson we didn't learn in 2008-9, because a lot of what happened in 2008-9 was caused by leverage. We've doubled down on the leverage. We've got even higher leverage today, and leverage in terms of to the tune of 320, 330 trillion in global debt. That's far higher than it was in 2008-9. Leverage to the tune of quadrillions in notional value of derivatives. That's far higher than it was at any time in history, and including 2008-9, we're way above those levels on derivatives. Derivatives are leverage on the markets, both bond and stock and metals, leverage on any market, whereas debt is leverage on the economy. So we've got both. And that's probably the biggest reason why I think a what would be a normal downturn can turn into something much bigger. So then that's what a bust means, is it's going to be something much bigger than we're typically going to see in a downturn. And it's going to be both economically big, but probably more so financially big because of that leverage. So that, part of that is an 80% decline in the stock market. Some of that is because of derivatives, and some of it is because of, we're up in the stratosphere and going even higher here, historically. So that leaves a lot of room down underneath for it to fall. You've got, as you said, it's been decades of excesses building up, not just debt and derivatives, but excesses, imbalances, all kinds of things where we have risks in our system today that we, far higher than we've had in going into other downturns. So that's another part of it. As I say, the pandemic, even though we're several years removed from it now, the response to that pandemic, don't forget, we shut down the worldwide economy pretty much for a quarter, and then had to respond with all kinds of stimulus to make sure that we held things together, because never had we ever said, hey, we're shutting down everything. We've had recessions where things shut down, et cetera, factories close or layoffs happen, all of that. We shut down the economy. We said, mom and pop stores, you can't open. Anybody wants to shop, you have to go to Walmart or Target. And this happened all around the world where, factories shut down, everybody stopped operating for a quarter. But in the meantime, the Fed printed $5 trillion. All central banks around the world printed like there was no tomorrow. We had never printed that much, both here and abroad. And we did other things in the pandemic, from a fiscal side, trillions and trillions of handouts and new money and all kinds of things to keep people solvent, because we shut down the economy. So that all, although it worked, we salvaged the economy. We went merrily along. We had a short 2-quarter, if you want to call it a recession, in 2022, and certainly a bear market in 2022. But other than that, we came out of that, and we're still reaping the benefits of all that stimulus. It's one reason why this thing keeps stretching out. Everybody wonders why. I talked about a bus coming. I started talking about that long ago, several years ago, and it keeps getting stretched out, and the top in the stock market keeps getting stretched out. It's because we've had unprecedented stimulus back in the 2020 and 2021 period, and it's still working through the system. But that leads to what I call fragility in the system, is that underneath the surface, statistically, the economy has been, humming along. Stock market obviously has been humming along. But down under the surface, you've got a lot of people struggling. You've got a lot of small businesses that have closed or are barely getting by because they never really fully recovered from what happened in the pandemic. All that is kind of, when things do turn south, because it is more fragile, it just adds to the depth of the downturn. So those are things. And then the third piece of this, is central bank policy. And although it's not evident yet, I think the Fed is making a big policy mistake. They're restrictive, and everybody looks at rates, but you also have to look at the balance sheet. You have to look at the money supply, and we've shrunk the balance sheet by $2 trillion in the last few years, 2.5 years, maybe a little longer, and that I have a monetarist bent to my work. That always at some point will come back to haunt you in terms of having an impact negatively on the economy. If you're shrinking money supply, typically that's going to have an impact. So I think the problem is it's not an immediate impact because we had all that money in the system. So yes, we've gone from 9 trillion to 7 trillion, in the Fed balance sheet. However, during the pandemic, we went from, you know, 3.7 trillion to 9 trillion. So that's still a lot of that is still kind of what's keeping us afloat. Um, so I do think, yeah, that we're coming to a point where that restriction, that monetary restriction that's been in place for the last few years is going to start to bite. And I think that, that combined with the tariffs and all things could come to a head as early as this summer. And you could be, you could be when the NBER, National Bureau of Economic Research, who's responsible for dating recessions, they do it after the fact. When they come in after the fact and date this recession, it oftentimes starts before we ever knew it started. So it's possible, even though right now, I think Atlanta, the Atlanta Now numbers might be still above 4% for the second quarter. I'm not sure I believe that. I think it's possible we could be in recession already. Or certainly, lots of industries or consumers may feel like they're in recession at this point. And as we move through the second half of the year, I think we will see negative GDP and ultimately more morphing into the bust. So bust just means a downturn that turns a lot worse because of the leverage. That's really the crux of it. And it will mean they'll need to be to pull us out of something like that. And again, this is worldwide. This isn't just the U.S., even though my focus is the U.S. You will see every central bank having to come in even bigger than in 2020. They'll. I'm predicting we could see 20 trillion coming out of the Fed. So we went from 9 to 7, and then we could go from 7 to as much as 30 trillion, because you're going to have a free falling banking system. I think you're going to have bank failures kind of dominoing across the globe. And, central banks can't sit back and say, well, we're not going to do that again. We said we're not going to print money again. We're not going to respond to, if they do that, everything's lost. They won't do that. That's the easiest prediction I can make, is when that starts happening, you will see QE at a level we haven't seen before.
Yeah, that probably is the easiest prediction on your part, is the pivoting back to QE, although they definitely would not say anything close to that right now. Of course, even just yesterday, kind of hearing Powell, the language he used, it sounds like he's still very hesitant. It seems like he's very confident that he's correct in staying at higher rates and in continuing to kind of be a net seller of treasuries and not even going anywhere close to QE again.
Now he
But
has stated we are not going to go back. We are not going to repeat the mistakes we made in the post 2008-9 era where we did, and again in 2020 where we went to ZIRP policy, zero interest rate policy, and where we created all these excesses. So in his mind, that's off the table. But that's because he doesn't realize, if I'm right, that a bust is coming. It's easy to talk that way if you think you've got a handle on things, and you can kind of keep an economy somewhat steady. It can go into recession, but it won't be a hard landing. It's easy to say in that event, we realize the mistakes that we made, that the central banks made last cycle. We're not going to do that again. The problem is, that's easy to say when you're not staring into an abyss where everything's crashing all around you. And it's not a matter of the Fed propping up the stock market. It's a matter of the Fed propping up the financial system. When you really see a financial crisis where banks are failing or are almost failing, the Fed cannot sit back and say, yeah, but we said we weren't going to do this again. They'll be faced with, if we don't do this, what happens? This thing could crater. So they will start timid. My prediction is that they are held back, just like yesterday. They're still fighting the last war. They're worried about inflation when I think deflation is the risk. So they're kind of still fighting the last war, and they will continue to. When let's say they're faced with starting to see, troubles in the banking area, and troubles in the economy, they might say, well, we're not going back to what we did before, but we do have to provide some liquidity. We're going to put $1 trillion in just to stabilize things, but we promise you we're not going back to zero interest rate policy. Then they do that, and they wait a little while and things are still cratering. They say, well, we got to do more. We'll do a couple trillion more or a few trillion more. Well, I know we said we wouldn't do this, but we have to. We can't risk the banking system going under, so they'll do more. And again, it won't be nearly enough to offset what is a huge unwind. So ultimately, it'll take several steps to get to a place where they say all bets are off. We just got to go, full speed ahead with money printing, with and they'll be accompanied by the Treasury issuing all kinds of debt, policymakers and the government coming up with all kinds of programs, just like they did in 2020 to save the bond market, to save the money market, to save pension funds, to save individual, to help consumers or individuals. They'll come up with programs we haven't seen yet. I think because this will be so bad. All that takes time. So to get to what I call right size policy, where they overcome the the issue of we're not going to make that mistake again. Ultimately, the markets will force that, or the economy will force that. But it will take many months for them to get to that right sized point. And in the meantime, that's why things will continue to tumble down. That's why you'll have what I call a bust. Because I do get that on from questions like that also is, or statements. People will say, you're wrong. That can't happen because the Fed will print money and stop that from happening. And I'll go, they may want to, but they're going to be slow to recognize what they need to do, and it's going to take them a long time to overcome some of their resistance to doing the same thing again, because they got criticized terribly, right, for years over what
Yeah.
happened in 2008-9 and what happened in 2020. Paul's very much aware that people think that was a very bad, that's what led to the inflation in 2022 in at least in people's minds. I think rightfully some of it was that. And he's very aware of that. So he is fighting inflation more than he's understanding that deflation may be the risk.
Yeah, I'm curious to hear your thoughts on real estate. I think I asked you on a few times ago when I talked with you, but I mean, real estate's been at a very kind of elevated place the last 3-ish years after COVID, and it seems like in the melt up, maybe real estate could go a little higher, especially if rates come down in the melt up. But then it sounds like in the bust, real estate could be hit pretty hard, especially like some, southern states or markets where you have a lot of excess inventory and things like that that could be hit hard. But I'm curious to hear your perspective there.
Yeah, so I think real estate peaked, 12, 18 months ago, maybe in some places longer ago than that. We're up, we're at a high level of that peak. So we're not, it's not rolling over hard, except, maybe in Florida and Texas, you are seeing, some pretty big give ups in price there. So, and inventory has really jumped in those areas or some of those areas. So real estate has peaked in my mind, more than a year ago. There are probably pockets where you're seeing higher prices, but activity is slowing. Inventories are starting to jump, and not just increase a little bit, but starting to jump in certainly some areas. I think what you could have this summer is, if I'm right, the rates are about to come down sub 4%, maybe as low as 3.5% this summer, maybe lower. That means mortgage rates could fall by a point or two, point or point and a half, maybe. There's a lot of pent up demand out there that couldn't afford, a 7% or a higher mortgage. Couldn't, just couldn't handle the price increases that were out there. If they get a little bit of relief on price, and we are seeing that people are giving up some on their asking prices and stuff, and they get some relief on the mortgage rate, I think you're going to see some of that pent up demand. We've had some of it already in spring, but some of that pent up demand could allow for a bounce, and not new highs, not a big turnaround, new leg in real estate, but a bounce in real estate that carries you through the summer or into the fall, depending on how weak things get economically here. So it's kind of a race, how much of a bounce, whether it's if things hold together on the economy longer and rates come down because of inflation and what have you, you could get a bigger bounce. If, on the other hand, the economy really starts slowing and going, clearly showing negative GDP this summer, even the lower rates may not be enough to give you much of a bounce. Get maybe some, but because it's kind of that two pieces to it. It's both the consumer has to have the wherewithal to do it, confidence in their jobs, etc., but they also need the break on rates. So both will have to play out to get a bounce. But I think you will see one, is my guess. And that's another, if you think about that, and that's probably a little true in autos too, although you get the tariff issue there. So I'm not sure how much in autos, but lower rates could stimulate both, the big ticket items, both housing and autos, and maybe other areas like appliances and things. To an extent, tariffs muddy that a lot, so I don't know how much we'll see it outside of housing. But if we get it, that helps keep the soft landing alive, because you get some of that bounce from rates, the stimulus from rates. And so it might be another reason why we can have things looking a little farther out. You realize things are really looking, for somebody like me who does look out and looks at other things, you realize this thing could get really negative fast, but it won't look like that in the numbers, in the data, for maybe another month, 2 or 3. And for people like Powell and his FOMC committee members who are data driven, they may be blinded by the data, when in fact under the surface you keep looking and saying, wow, this thing's going to get worse and worse, but it's just not showing up yet. And so that may be part of why you can have recession coming and yet the stock market have its biggest rally in history, because it's not as evident as it may be evident if you really look at the bigger picture, but it won't be evident in the short-term data.
Yeah, that's interesting to think about too, how housing could play into that. Because for so long, I mean, not so long, but I mean, 3 years, it's been just a market where not a whole lot of anything has happened. And so if it picks up a little bit, that could definitely spill into fueling more optimism for sure in the markets.
Now, the other side of the coin is that, and it's true of the equity markets, it's true of housing, it's true of all assets. When we roll over, when we get to the top and go to the other side of the mountain, the other side of the mountain is very steep. And this whole thing about a global bust, I think you could have home prices down 30 to 40%, certainly in many areas, and maybe across the board. That probably only gets you back to 2020 prices, but
Might not.
Yeah, might not even get that far back. But for those that have bought in the last few years, if they get a 30 to 40% hit, they're not going to be feeling too good. And many of them probably won't be able to hold on to their houses, because, if they lose jobs or, other things happen. So it's, I think we're in for a rough slide in housing not very far from now. It's just the summer may not show that yet. Yeah, you could get that bounce.
Yeah, no, thanks for talking on that. I know that you say you don't follow platinum. The market or the platinum market has rallied a lot this year, but is that something that you could see maybe participating with the melt up? But yeah, you don't have to comment on it if you don't follow it though.
Yeah, I don't follow it. So what I will say is it's not
Okay.
unusual for platinum to track with gold and silver. So it doesn't surprise me. I really don't follow it at all. So I'm not somebody that's going to comment on that. But it in previous cycles or previous times, it certainly is another precious, so-called precious metal that tracks the other precious metals. Not always
Okay. No,
directly, but pretty close.
yeah, thanks for talking on platinum real quick. And I know that I want to be respectful of your time, David. I just want to let my viewers know where they can find you. You're on Twitter pretty much every day at Dave H. Contrarian. I'll put your link to your X or Twitter account in the description of the video. And of course, you have a letter by subscription as well. Let my viewers know where they can find you, how they can get signed up for that.
Sure. Yeah, my letter is a quarterly letter, macro letter. So it's not, there's not advice in there. I'm not giving trading ideas. That's not what I do. It's a macro letter. So it fills in a lot of the blanks that I can't do and shorthand on X. X is, you have only so many characters. I do a pretty good job of, responding to people and getting my thoughts out. But, in a quarterly letter, I can lay out more my rationale and in a more thorough way, et cetera. So it's by subscription, so it comes with a cost. If people are interested in it or might be interested in it, they can direct message me on X, and I provide details there. Um, Occasionally, I have people on X asking, and I'll just direct message back to them the details. So you can do it that way too. But um, in terms of being on X every day, I just want to tell people I have this happening all the time. People say, I haven't seen you in a long while. And I'll go, that's because I don't do a lot of original tweets or original posts. Most of my posts on Twitter or on X are replies to people, other people who ask questions or make statements that I comment on. Um, you will not see those if you don't have your settings set right. And I'm not an expert on how X works. Through conversation on X, when this has come up, what I have gathered is that you have to, there's a bell. If you go on my profile, you'll see the bell and you click on that. And within there should be a place that allows you to say, receive all, posts or all, both original and replies. Um, Unfortunately, it seems, I don't know why X hasn't fixed this. It seems like that option may not be available unless you're doing it from your phone. You don't see check, both replies and original posts. So for those people that are not seeing me on there every day, you're missing a lot because I've replied 20, 30, 40, 50 times a day to people. Not always, sometimes it's a dozen or less, but a lot of times it's much more than that. If you're not seeing those day by day by day, it means your settings aren't set for that, and you're going to miss pretty much everything because about the only original replies I often make are these interviews. I'll retweet these interviews, um, and or put out an original post with the link. So I feel sorry because I've got 217,000 followers. I have no way of knowing how many of those 217,000 are missing the majority of my posts. They think they're going to get notified when I post, but not for replies unless you're set up for that.
Yeah, no, thanks for laying that out. You are very active on Twitter. I just have to go and view your replies, and they all show up for me, at least on my phone. That's how I view it. So
Yeah,
it
that's
comes
the other
well
way
for me.
people can do it is to go to my profile and every day and just look there. You know, if you want to, at the end of the day, just go and say, it's, you know, you can look on my profile and there's a list of all the replies there where you can scroll down and look at them that way. But if you want, you know, kind of minute to minute on, you know, date up to date, seeing the replies when they come out, you've got to have your settings set right.
Yeah. We'll reach out to him on Twitter at Dave H. Contrarian if you're interested. David, thank you so much for coming on today.
Yeah, thanks, Logan. It's great to see you. Enjoy your summer.